Without further ado, Mr. Karl Frank.
Thanks, Chad.
Good luck.
Thanks, buddy. Yeah, good luck. That summed it up. How is everybody doing? You doing all right? I'm so happy to be here. So thankful for you showing up, and everybody online. Thank you for joining us online. Um, it's apparently some things have happened this year. I'm going to give us a little market update, an economic update, as well as talk about the overall situation here and our forecast. So give me a second. There we go. All right, got to be careful. Hey, remember that your friends are welcome to interview with us. We go up to 3 meetings free of charge. So please take advantage of that. I'll put this slide up at the end of today's presentation, and you can scan the barcode or just make an introduction, and we'll schedule that appointment for you. We'd love to get to know your friends and family. They may have some questions, and within 3 meetings, you can get a lot of free financial planning advice at the beginning that might make an impact in your life. So take advantage of that. We offer up to 3 meetings free of charge. Well, the market, I'm going to read for a little bit, if you don't mind, because things have been interesting if you haven't heard. And they might be, if you just looked at what happened in the first 3 months, less interesting than you think. U.S. equities underperformed foreign equities in the first quarter. U.S. large cap stocks trailed during January and February and have done better in March. And year to date, even better since then. So since the Iranian conflict started at the end of February, much of the decline in equities so far has come from multiple compression with earnings expectations remaining in the double digits. This is good news. That's a fancy way of saying companies are profitable. In fact, they're setting record profits. Even though the prices are volatile, the companies are doing well. International equities outperformed U.S. stocks over the full quarter, but were not immune to the March drawdown. Developed markets were up double digits through February and gave back most of that in March to finish with a first quarter loss of 1.2%. And emerging markets had a small loss of 0.2%. Again, April changed everything for the better. After cutting rates 3 times last year, the Federal Reserve held rates steady at their 2 meetings so far in 2026. Since the onset of the war, additional cuts in 2026 have been priced out of market expectations. I'll talk about that in greater detail soon. Both investment-grade core bonds and high-yield bonds finished the quarter essentially flat. The winner for the year are the alternative investments on the right-hand side, and many of you may have some of these in your portfolio. And lo and behold, they did their job. They went up when other things went down. Not a bad quarter. The news sounded horrible, but your investment accounts, if you only looked at those, looked good. There's a disconnect, and that's going to be a theme for today. It feels like we're battling ourselves is a theme for today. So the conflict in Iran is the big news, and the military operations in Venezuela, lest we forget, that also happened this quarter, right? It's been a huge 3 months in the geopolitical world and very, very small effects on our portfolios. What this chart is showing is the geopolitical risk index, and you can see it's spiked. It hasn't been that high since the crisis when America was bombed in 2001, before some of the people in the room were born. Equity markets were largely resilient amid the conflicts, but U.S. large cap stocks did fall 6% from their peak. That's not that much, right? In a given year, an average equity decline is 10 to 15%, and the market rallied back from this decline really quickly. However, for now, the economy continues to expand. Corporate profits are expected to increase double digits this year. And in fact, since these slides that end, all the data here ends on March 31, the corporate earnings have been coming in exceptionally good. Again, more on the conflict in Iran. U.S. equities held up relatively better since the start of the war. A stronger U.S. dollar, which rallied 2.4% just in March, contributed to some of this, with another likely explanation that the U.S. is not as reliant on Middle East oil as other countries are. Concerns about increased inflation from higher energy costs caused rates to back up during March. Bonds also faltered along equity prices in March as U.S. car bonds fell 1.8%. The chart that you see here shows you January and February in yellow, March in blue, for almost anything you could have invested in. And you can see a lot of difference between the two. So yellow starts out great. The year looks amazing. 2 months into the year, some of these things are up 7%, 11%, 15%, 14%. Just in the first 2 months of the year. And then all of a sudden, the more volatile up, the more volatile down for almost all of those things. Some of the exceptions here on the right, the dollar rose in March considerably, reversing that downward trend. The US dollar compared to Japanese yen also went up. And of course, commodity prices, as we know, went up. And that, of course, means there's some inflation concerns. More on that in a minute. History will show you that this is probably a blip. So the chart you see on the screen shows every war during your life. The first row shows the biggest, World War II. Geopolitical shocks may spark sharp downturns, but their impact is typically short-lived. Look at the farthest right column, and you'll see how the market was doing 252 trading days, a year after the event began. Markets adjust within days or weeks of the surprise, awful geopolitical thing happening, and then a year later, they baked it in. Unless the war in Iran materially changes the path of the economy and inflation, risk assets can remain supported by strong fundamentals. So look across that first row, you'll see World War II, and a year later, the market was still down 16%. Look at Pearl Harbor when we entered, and the market 252 days was only down 2%. How about that? Look at the third row, Korean War, the forgotten war. The market actually rallied up 15.8% during the Korean War. Look at the last rows, the most recent. And this will be a new one, the one that just began in Iran. The Israel-Iran 12-day war, which happened in June and July 2025 last year, the market actually went up during that. And of course, we haven't had it for a year, but it was up 13% recently. When Russia invaded Ukraine, a year later, it was down 9%. The year before that, the time before that, when Russia invaded Crimea, it was actually up 10%. Look at the averages of all of these. And a year from now, you're getting between 8.4% and 9.7% average annual return for the market. That's what's within the average range for the markets to begin with. Markets tend to deliver 9, 10% per year. Equity markets are doing just fine during these international war conflicts. And that's really hard for us to digest. It's really scary. But some companies do well. When the government blows stuff up, companies have to rebuild it. Right? Some things actually do well. And it's a horrible thing to think about. The good news is you don't have to pick those companies. You can just remain diversified and you'll do fine. So history shows this is probably a blip. The thing that's not a blip is oil. You can see the price of oil. You can see the Strait of Hormuz remains closed, I think. I mean, check tomorrow. Maybe it'll be open, right? Every day, open, close, open, close. What this chart is showing you here is the average number of ships that travel through the Strait of Hormuz is kind of a iffy line, but maybe you could even average it more simple and say about 60 ships, oil tankers a day travel through the Strait. And of course, that's been dropped to zero, the lowest that it's been since 2020. The recent fragile ceasefire has allowed some tankers to transit the strait. However, traffic through this key choke point remains well below where it was prior to the conflict, and that may persist. That may persist. So what does that mean? Well, what people worry about is that oil leads to inflation, but it's oil prices that are up and not inflation. So you can see on this chart since 2020 that we have recently reached oil prices that we had not very long ago in 2021. Oil prices spiked during the Russia-Ukraine war in 2022, preceding a jump in inflation. However, energy costs were not the sole contributor to the inflation we faced just a few years ago. Extraordinary fiscal stimulus, and if you were listening to us talk back then, you would have heard me say the same thing. That was the bigger influence on inflation just a few years ago. Broken supply chains, this became unfortunately very apparent during the COVID crisis, a hot labor market, and record low interest rates contributed to inflation just a few years ago. So oil does not necessarily lead directly to inflation, even though the prices are at where they were when we had inflation prices, even though we're paying in America on average $4 a gallon. If you're in California, over $6 a gallon. And if I don't know where is cheaper than that. I think Colorado generally has some of the cheapest oil and gas prices in the country, and we're hovering around $4 a gallon right now. So what is the problem with inflation? Well, inflation is shown here, and that history, of course, goes back to 2020, very similar. The chart shows oil in pink, so you can see the contributors to inflation. It's a really rough color to see on the screen. I tried to make it something that wasn't so ugly. But the Fed research shows higher energy costs added roughly only a 0.5 percentage point to the inflation rate. in 2022 when inflation spiked to this mountainous shape here. There were many contributing factors to the 9% inflation that we had in 2022, and they're not here today. You can see the gap here was the 2 month vacation the federal government took. The data didn't come in, but you can see that the inflation rate today is even lower than it was just a little bit ago. Now that will probably change, and that's the next slide here, predicting where things are going. The market is the best indicator of where things are going, and the market's predicting things are going to inflate. Things are going to get more and more expensive. So the chart shows every major economy with predictions for inflation before the Iran conflict and after the Iran conflict since then. So higher energy costs are expected to add higher inflation readings than previously expected. Inflation expectations for 2027 were lowered from previous estimates, signaling an inflation outlook where higher oil prices are temporary. So think this through. The first set of columns there is all the G20, and you can see inflation is supposed to add about 1.2%. That's the same percentage cost increases for the US to take inflation from 3 to maybe 4.2%. After the Iranian conflict, that's what people think. That's a pretty big cost increase. So going from 3% to 4.2, 1.2 divided by 3 is about a third. So that's a 30% increase in inflation rate, but that doesn't mean a 30% increase in prices. You can think about this as if you spent a dollar, maybe it's $1.04, where it would have been $1.03. Europe is similarly hurt. Brazil isn't hurt at all on the right-hand side, and you can see India is the worst hurt. India is the most vulnerable to oil prices in the Strait of Hormuz. And this is not a crisis that we're in alone. This is something that's happening all around the world. And so I think what could have come out of here are some pretty big changes. But what this could mean is that anybody who's hoping on lower interest rates may be disappointed. So the Fed may not be easing. And what this chart is showing here are forecasts for future months in the year, with the last one being by December. The market is thinking that maybe the Fed might perhaps still lower rates by 0.5%. If you were at the presentation I gave 3 months ago, the market was optimistically forecasting maybe another 25 basis point decrease in interest rates by now and another 25% decrease in interest rates by June or July. That's not so likely now. They don't think that's going to happen. Energy-driven inflation fears rattled global bond markets, sending the U.S. rates up between 35 and 45 basis points. What that means is between 0.35% and 0.45% of a rate. That's a pretty big change. I'll show you what that means here in a minute. Markets have sharply repriced central bank expectations, and investors now expect the Fed to not cut rates this year, down from 2 cuts anticipated at the beginning. So you can see after the Iran conflict, not likely that we're going to have any rate cuts. Bummer. Bummer for high growth companies. Bummer for people who are borrowing money, but not necessarily bad news for investors in bonds like you or I. Short-term inflation expectations have increased, but long-term expectations remain muted. So this is good news. The spike in energy costs has caused short-term inflation expectations to increase. That's the top chart. You can see the one-year inflation expectations are really high, much higher than they were before, but the long-term inflation expectations remain anchored, and that's the bottom chart. So not much of a change in inflation expectations due to the war. Unless long-term expectations increase meaningfully, central banks can likely look through any jump in headline inflation and maybe resume their previous course of possibly in the U.S. lowering interest rates in the future. But right now, it's not a prudent decision. It doesn't look like the markets are not thinking that it's going to be in the cards for a rate cut, which would, of course, be a boost to our equity investments. All right, so that's the big picture effect of the macroeconomic decisions, that the geopolitical problems, that the headline news, that the social media feeds, that the conversation around the gelato table, right? Everybody's eating gelato, right? That you're having, right? That's the macro are kind of like, well, maybe over the short term, maybe I'm paying more at the gas pump. Maybe, electric cars might be doing a little better. Gas guzzling cars are still booming in America. Not much is the bottom line. right? And this could dramatically change. It dramatically changed in April for the better in all ways. U.S. companies, despite single-digit decline in the S&P 500 during the first 3 months of the year, there's a lot of divergence under the hood. And so what this chart is showing you is the percentage of companies in various sectors with greater than a 20% decline in their share price from their 52-week high. And you can see that different sectors were hurt differently. Energy, for instance, had nobody have the share price go down. Not a single energy company had their share price decline in the first quarter. I don't know if that's ever happened. It did. More than 40% of the companies inside the S&P 500 are down 20%, were down 20% or more from their 52-week high, even though the market was down just a few percent. Remember when I started the market out, the report out today with the market returns, they're flat to a little bit up. The divergence is most evident within tech stocks, where nearly 60%, nearly 2 out of 3 companies in technology sectors declined during the first 3 months of the year. Diversification is really good. And within the technology sector, software names have sold off amid concerns around AI breakthroughs that could disrupt their business models. And I presume we'll have some questions about AI here in a bit, because I'm extremely optimistic about what that means for our investment portfolios. And during April, who has led the rally up? All the companies that declined the most in the first 3 months. So we have to be a really humble investor today to be thinking that we could time that would be impossible, to be thinking that that anything other than the company fundamentals will be driving long-term returns, I think is naive. And the company fundamentals, like I said before, are really strong. There's a great, and market investing is also getting really good. So there's a greater share of S&P constituents outperforming this year. After 3 calendar years, I don't know why the footer got huge. After 3 calendar years of only 30% of stocks in the S&P 500 outperforming, in other words, for the past 3 years, only 1 out of 3 companies did better than the S&P 500. It was really hard to find an investment that did better than the S&P 500 average. This year, more than half of the stocks are outperforming. And this has been aided by the trend in favor of equal weighted indices over market cap indices, value stocks beating growth stocks, and smaller companies outperforming this year. If you drew a line along the middle there and averaged that out, you would see about half the time, half the companies outperform, and about the other half of the time, they don't. This chart goes back to 1973. That's a pretty long time. And so it's not a bad idea to be really humble, but also get really excited because we do have companies that are a little bit more profitable in your portfolios, and profitability is becoming more and more attractive to other investors. And so we're excited about the opportunities inside our investment accounts. We're excited about what this means for this year and the future. Another way to look at this is growth and value. At our firm, we say the right way to invest is to diversify by strategy. In other words, how the decisions are being made, how you're choosing the investment companies that are in your portfolio. And we don't pretend that we have the secret sauce, but we do know that one way to manage money is to invest in growth companies. Quickly growing companies tend to do well. Another way to invest is the Warren Buffett famous way, where you buy companies at a discount, where the price you pay today is really low. And if the companies are profitable, other companies will figure it out and invest more in it. So growth and value is a popular way to look at it. And this chart going back to 2020 shows that during this time, the market has gone up and down. Remember the COVID crisis, and then rallied big since then, with different types of companies doing well at different times. And right now, the past 3 years have been growth stocks way outperforming, and this year it looks like it might be reversing, with the value companies closing the gap. The gap between these two is closing, which is good for diversified portfolios like us. It's very good, in fact, for humble investors who can go the long haul. That gap is usually about where it's at and could get smaller. So that's a good sign for those of us who have a lot of companies underpriced right now. And that's you and I. If you're in our usual portfolios and looking around the room, I see most people are, as far as I can tell. Interest rates are big. That's really important to look at. So the long rates, the longer duration rates rose. What this means is good news, whether you think it is or not. So the chart shows interest rates in total. So the U.S. interest rates are in teal, and the European interest rates are in yellow. In all cases, U.S. pays a better interest rate than the Eurozone does. And on the left-hand side, you'll see the shortest duration interest rate. So if you just wanted to invest for 3 months, you get a lower rate. Then on the right-hand side, if you're willing to wait 30 years, you get a much higher rate. When it goes from bottom left to top right, that's a normal situation, and that's good. It's really healthy. The U.S. Treasury curve rose between 35 and 45 basis points since the Iranian war. The 10-year U.S. Treasury yield hit the high in March at 4.4% after being sub 4%. That's what the line below it is showing. Everything moved up. A steepening yield curve is a bullish sign. That's a good sign for us investors. It means that companies are going to have to take on more risk to borrow more money, and they're willing to do so. And they're willing to do so. And so this is a good sign for equity investors like you and I. It's a good sign for our bond portfolios. Our bond portfolios benefit from higher yields coming in. So that's the big macro. It's not a bad situation. On a company specific way, one of our favorite ways, and I use two research partners. One is IM Global Partners. IM Global Partners loves looking at credit spreads. They love bonds. They love interest rates. And what a credit spread means is that the bonds that a risky company issues and pays interest rates on are higher than the same from a low risk company. And a low risk company would be a really big company with a really strong financial statement, and a high risk company would be a smaller company that has already a bunch of debt. And the credit spreads are low, which means that the difference between these two are really low, which means companies are generally speaking really healthy. You can see this chart goes back to 1997, and there was a spike. And you might remember it called the global financial crisis, right? That was a much bigger effect on our portfolios than the things we're going through right now. Credit markets remain strong with investment grade and high yield spreads below historic averages. Spreads have marginally increased this year, marginally, very small, around the concerns in the Middle East. Private credit is a big worry. I think that there's a lot of news going around a company called Blue Owl, who's a private credit company. But IM Global Partner continues to like credit. Over the past several years, many companies have delivered, they've extended maturities, they've improved balance sheet quality, they're in a stronger position to withstand higher rates and slower economic growth. So it's good news and good news and good news and good news from IM Global Partners that you're not going to get from any of the places I just talked about, right? The behind the scenes story is very, very different than the headlines. And the volatility, if you were here in January, I said we expected, our research partners expected a really volatile year. Well, that unfortunately panned out, didn't it? Because that was a really volatile first quarter, and it was a really volatile to the upside April, and that's probably not going to discontinue. That's probably going to continue. That's probably going to be the story for this year. We're in a fraught geopolitical world. The president of this country is known for switching directions quickly, and that is a thing that happens all around the world. All around the world, countries are switching directions quickly. And one of the ways that that we simplify all this is with our other key research partner, Athena. And so Athena boils down everything that's out there in the macroeconomic and makes it into a little dashboard. And you can go to their website, athenainvest.com, and see the same information. And you can read the papers behind the scenes that describe why their academic research shows this. And they divide it into 4 categories. And the first is behavioral. That's their patent. So they won't give you all the keys to their castle on their patent. But right now, their predictions are that U.S. large cap companies will not do as well as pretty much everything else we can invest in. So Athena spent 2 months of this year during the war, before the war and during the war, in cash with their Athena market rotation portfolio. So that helped because that locked in a good gain for most investors if you had bought in it, with their previous trade. And then you wouldn't have lost money, certainly during that period of time. And then since then has moved into international. And you can see they like international and they like small companies. And so that's the Athena behavioral trick. And that's what they believe in. They believe that's where they should be invested. So that's one of the strategies we employ for a lot of our client portfolios. And we don't bet the house on it, but we also, don't get hurt by it if it were to be a lower performer. This year, it certainly helped. The economic indicators from Athena are normal. They're right in the normal range. There's nothing too exciting. It's not like this economy is just killing it. It's not like it's doing horribly either. It's a normal economic environment. The valuation is almost always in caution because our companies today in America, in the S&P 500, their prices are ahead of their earnings. right? So they're really expensive. But that valuation normal is coming back down. It used to be red. The earnings are catching up to the prices. And so that's very, very good news for us. That's very, very good news for us. Perhaps maybe, and we don't know all the secrets to the model, but that may be perhaps why investors are less excited about large caps today, because the prices are not appreciating, or they're not expecting them to appreciate at the rates that they were appreciating. Instead, all the other beneficiaries of AI technology, all the other small companies in the world, and a small company in America today is still tens of billions of dollars. It's almost up to $100 billion. Companies today are huge in America. And finally, the technical analysis says, hey, it's mixed, right? I mean, some are up, some are down. So all in all, that's not bad. That's a normal environment right there from Athena, and a good environment for equity investors, and a solid environment for fixed income investors. It's just a crazy economic time because of the news we're getting, because we want to act on it. But when we look back at every major military event of our lifetime, back to 1940, all the years that all of us have been alive, the impact has been short-lived. It might have been dramatic for the first few days or first few months, but even a year later, on average, across all these events, including the biggest, a year later, the market was within a few percentage of its long-term average. And so we got to find a way to stick in there. We got to find a way to be a little humble, to weather out a storm like this. I don't think the chaos is going to discontinue. I think the news is going to get more and more strange. And in the meantime, we're going to keep our money managers and our strategists focus on what they do best, which is find good companies and go bottom up. Bottom up. So that, in a nutshell, is what just happened. I appreciate you for listening to me. I am open for questions at any time about anything you want. And if you have any friends or family you'd like to invite, scan the barcode and invite them over. That's what I got prepared for us today. So there you go. Thanks.